Now we get to the financing section of the statement of cash flows. And this, you'll remember, involves your long-term liabilities and your stockholders' equity accounts. And for this, we go to the notes to the financial statements, and we notice that net income for the year was $93,000. And again, we actually do need the operating section here as well. When I did these on LiveScribe, which was the previous way I did it, I could just do an entire sheet. I didn't have to break it down into 3 or 4 sections. So that's why it's not totally smooth at this point. So you'll have to bear with me. So here's our financing activities. Okay. So our net income, we know, impacts retained earnings. And we know that net income increases retained earnings. Our net income for the year is $93,000. Our retained earnings started at $134,000. The $93,000 in net income would be an increase to the retained earnings. But we know we're not adding across yet, so there must be something else, but we'll get to that. We know in the operating section, we left the first spot for net income. And that is where it goes. So the first item in our operating section will always be the net income, and then the other side of it increases the retained earnings. Cash dividends of $35,000 were declared and paid, and this is the additional information. We know that that decreases retained earnings. So now when we go 134 plus the 93 minus the 35, we should end up here. Okay? Now, dividends are to keep our stockholders happy, and that's a financing activity. So we would simply go down here and say we paid dividends. You could say paid cash dividends if you wanted to. And it was a debit up here, it's a credit down here. And that makes sense because the cash flow effect is that it decreased our cash. Okay, it says bonds payable were redeemed for cash of $50,000. And that makes sense. They started at $200, they went down to $150. That means that we redeemed bonds for $50,000. And so that explains the top part. We'd go down to the bottom and say we redeemed bonds. And it was a debit in the top section. And so it will be a credit down here, which makes sense because if we're redeeming bonds, we're paying out cash to do that. Okay, common stock was issued for cash. So common stock started at $174. So a $42,000 credit would explain that that much more stock was issued. And we go down to our financing section and we tell everybody that we issued some stock. And say credit up here, it's a debit down here, and that makes sense because when you issue stock, you get money. Okay, so at this point, what you would do, you've got all of the adjustments made, you'd probably take one final sweep through it. You'd make sure that the total of these entire columns added up all the way from the top to the bottom, including the top part where the comparative balance sheets are and the statement of cash flow effects. Those should add. And then you want to make sure, just going across all your accounts, that the beginning plus whatever adjustment minus whatever adjustments equals the ending balance, and that you haven't missed anything. Once that's done, then we can get to the part where we complete the worksheet. And actually, this is about as far as the book goes, but I add one more section, which I can show you in another very brief video.